ICICI Lombard General Insurance, the largest private sector non-life insurance in India, reported a strong profit growth of 28% in Q1 FY21. In our ideas for profit today, I'll delve into what has really led to the robust performance in Q1, that's despite the COVID crisis, and more importantly, will it sustain? Well, for sure, the business growth was impacted by COVID-19, and the same is reflected in the gross direct premium income or GDPI of the insurer, which fell by 5.3% in Q1 FY21. That's on a year-on-year basis, which was a tad more than the overall industry, which actually saw the GDPI dipping by almost 4.2%. Now, on the other hand, it was the lower claims in the motor business due to the lockdown that has actually led to the strong profitability in Q1. However, this won't sustain as the situation will reverse in the coming quarters and there will be a pickup in the business, but the claims may also climb up as vehicles have started to ply across the country now. Now, in the aftermath of COVID-19 breakout, a number of regulatory relaxations were extended to the policyholders. For example, on April 16, 2020, IRDAI had announced an extension in the renewal of the third-party motor and health insurance premium payments. This had led to a short-term impact on the premium collections as customers deferred the renewal premiums as well. Now, motor insurance, which is the largest segment, actually saw the GDPI plunging by 22%, but the property and casualty segment grew by 20.5% in Q1. Now, the bigger concern for the general insurance industry is the slump in new vehicle sales, which would impact the growth trajectory for the motor insurance. Now, management expects fire and health segments to grow reasonably, but other business lines, say marine and engineering, may witness some degrowth due to the reduced economic activities. Also, travel insurance is a big hit for the company. The insurer also launched a number of COVID-19 specific health insurance products during the quarter. Retail health indemnity new business was up 26% in Q1 of FY21. Now, overall speaking, in the near term, we see increased traction in the business due to the inflow of the deferred renewal premiums. But after the initial jump in Q2, there may be a slower growth in the premium in the rest of FY21. Now, in the long term, we see the health insurance business gaining prominence and contributing more to the insurer's premium income. ICICI Lombard's combined ratio, that's a measure of the insurance company's profitability, that is actually reduced to 99.7% in Q1 when you compare it to 100.4% last year. Now, the combined ratio of below 100% indicates that the insurer is receiving more money from premiums than payouts in claims and, say, operating expenses as well. So that's a bit of a good news. Investment income in Q1 also decreased by 5%, and that was mainly due to the lower capital gains even as the investment assets increased. Now, ICICI Lombard capitalization remains healthy. It is reflected in the solvency ratio of 250% as at the end of the June quarter. Now, at the current market price of, say, 1318 rupees, it is trading at a premium valuation of 9.2 times the trailing book, which is quite rich. But being the leader in the company, in the sector as well, delivering an ROE of, say, 25% along with the decent earnings growth as well, the company's premium valuations will sustain even going forward. That said, investors need to also understand the risk underwriting business is highly volatile. Also, the insurer's profitability is highly contingent on the investment performance. External factors like fall in the credit rating of the debt holdings or adverse movement in the equity markets could actually impair the value of the investment portfolio. Now, given the premium valuation, the near-time upside in the stock is limited. Nevertheless, investors with a long-term horizon and wanting to participate in the growth in the non-life insurance sector can consider buying this stock on dips going forward.